Nothing is built to last anymore. And that's not a mistake. It's the business model. Your phone battery, your washing machine, your shoes. They don't fail randomly. They expire strategically. And once you see the pattern, you won't unsee it. You've felt it. Your battery health drops after 2 years. Your appliance dies right after the warranty ends. Your software slows with each update. Your clothes lose shape after a season. And every time you think, quality just isn't what it used to be. But quality didn't disappear. Incentives changed. Margins compressed. Companies competed on strength. Appliances lasted decades. Furniture was repaired. Electronics were opened and fixed. Longevity built trust. But then the economy shifted. Global manufacturing scaled. Competition intensified. And public companies faced a new reality. Quarterly growth expectations. When growth becomes mandatory, durability becomes complicated. Because durable products slow replacement cycles. And slow cycles slow revenue. Old model. Build something strong. Sell it once. Support it long term. New model. Release frequently. Refresh design. Accelerate upgrades. Velocity replaced longevity. And one company helped normalize that shift more than most. Apple. Apple didn't invent planned obsolescence, but it perfected upgrade culture. Annual iPhone releases. Incremental improvements. It's defeated by wanting something new. Slightly thinner devices. New finishes. Sealed batteries. Complex repair paths. None of this guarantees failure, but it guarantees desire. And desire is more powerful than durability. Because durability isn't defeated by breaking. Think about it. When was the last time your phone completely failed? And when was the last time you upgraded anyway? That gap is where the upgrade economy lives. Now zoom out. This isn't just about phones, it's about cost engineering. Every product today is optimized on a spreadsheet. Durability adds, higher material costs, more expensive components, heavier shipping, longer replacement timelines. From a financial perspective, that's inefficient. Replacement adds, predictable demand, recurring upgrade cycles, higher lifetime value, clear growth forecasting. Markets reward predictability, and predictable replacement is easier to model than unpredictable longevity. That's not evil, that's structural. Look at fast fashion. Look at budget furniture. Look at entry-level appliances, thin materials, shorter production timelines, lower repairability, convenience over craftsmanship. IKEA didn't destroy durability. It optimized accessibility. Flat pack logistics, affordable design, mass production. But affordability often trades off with longevity. And when consumers prioritize price and convenience, durability moves down the hierarchy. There's another layer. Repair became harder. Sealed components, proprietary screws, software locks, restricted parts. Repairability slows upgrade cycles, so repair becomes less accessible, not because engineers forgot how to build, but because the economic model favors replacement. If a product lasts 20 years, revenue becomes unpredictable. If it refreshes every 3, growth becomes measurable. And measurable growth attracts capital. Capital increases pressure. Pressure accelerates cycles. But here's where it gets uncomfortable. Consumers say they want durability, but behavior rewards novelty. We line up for new releases. We chase redesigns. We upgrade for marginal improvements. We value new over long-lasting. The system didn't force this alone. It adapted to it. That feedback loop is powerful. Now think about the broader economy. What would happen if products truly lasted forever? Smartphone sales would slow. Appliance markets would shrink. Fashion turnover would collapse. Quarterly growth would flatten. The entire consumer economy depends on motion, on turnover, on replacement. Stability doesn't excite markets. Velocity does. And velocity depends on expiration. So when you say, nothing lasts anymore, you're partly right. But not because companies forgot how to build, because they optimized for something else. Convenience, speed, design refresh, upgrade cadence, predictable replacement. Durability didn't disappear. It became optional. And once growth depends on cycles, longevity becomes inefficient. Inefficiency doesn't survive scale. The real question isn't, why do products break faster? It's, why does the economy reward replacement more than resilience? Because once you understand that, you stop seeing failure as accident and start seeing it as alignment. Alignment between incentives and outcomes. Nothing lasts anymore. Because lasting doesn't compound revenue. Upgrading does. And once you see that pattern, you can't unsee it.